So in this part, we're going to go through managing your positions around trades, or just generally tips on trading around news in general. So I'm not going to take you through a specific strategy, but just give you tips on whether it's a good idea to open trades right before news, sort of what you could do if your trade's already open and there's high impact news coming out, just general ideas, because of course, everyone's going to have their own strategies over time, and therefore you're going to find your own ways to manage trades or open and close trades around the news, but I'll give you these general tips and pointers. So that obviously gives you a good base when you're starting out. So as we've already looked at before in the previous parts, we know that economic data and indicators can give us pretty quick spikes in the price of the pair that you're looking at. So on top of that, you also have things like central bank speeches, maybe the minutes of a meeting being released. All of these sort of like unknown events can also cause volatility in the markets. And at the end of the day, you don't know exactly what's going to happen. It's pretty much impossible to predict exactly what way things are going to go. It's definitely impossible to predict what data point is going to come out or what number, but what you can do is prepare yourself as best you can for those eventualities potentially playing out. So what we want to think about is, let's say that the market is making a movement to the downside, and this could be any particular market, but let's just say that this is pound dollar. So we're going to have our pound market against the dollar, and the market's moving down, and let's say that you are looking at the chart as it's around here, so it's starting to make new lows. In 5 minutes time, you're going to have a large, potentially high impact UK data point coming out and releasing to the market. So you have to think to yourself, let's say that you're looking to take a trade here, or let's make it a bit more realistic and say that you're looking to sell as the market comes back into this previous low. And we're almost there. And in 5 minutes time, you've got perhaps a UK interest rate, a Bank of England interest rate decision coming out. You got to think to yourself, is it really the best time to be either opening a trade now or setting limit orders or stop orders to open trades in the near future? Probably not, considering the price is very close to where you want to get in. So we know that a lot of these indicators, sometimes it can be high impact and it doesn't make a difference, or it can even be like a medium impact and make a massive difference. It depends the context around it and how different that figure is. But in the case of an interest rate decision, let's say, it's obviously one that you should not be trading near to, because it's highly likely that this or the press conference after or the meeting minutes could give you a pretty nasty shock. So let's say that you're looking to go short now at this price, and you place your stop loss maybe, let's say, above the swing high, and the market could easily spike you out and then spike down and then do all this crazy movement and then end up going to where your target was going to be. So it's not a good idea in general to enter trades when the news is quite close. So there's no way to quantify it. It's not like it's got to be within 30 minutes or 2 hours. It's just be sensible about it. So obviously if you enter a trade on a Wednesday and there's a potential high impact news event Thursday afternoon, that's okay, because there's an entire day in between where price can make a move and the actual trade can start to play out before that news comes, and you can then come back, and we'll look at this in a second, and sort of decide what to do then. But of course, if you're looking at the market and looking to enter 2 hours before NFP, non-farm payrolls, is a pretty big event, first Friday of every month, it's not a good idea, because it's a well-known event for spiking one way, coming back the other, spiking back the other way again. So it's just not worth the risk, because essentially what you'd be doing in that point is taking a 50-50 bet directionally that the market might move in your direction. So you've got a stop loss here, take profit at the low, just a random example. And if you then sell the market here, let's say you see a shooting star forming and the market closes, you place an entry here, the news is coming out 30 minutes later, you're essentially just placing a 50-50 bet that the market's going to do this instead of do that, because there is no real directional edge when there's an unknown event coming out soon. So of course, sometimes you're going to have an event that you don't even know is going to happen. So there could be a natural disaster that happens, obviously you can't predict that. Or let's say like a political event or any sort of event that can affect markets that isn't scheduled, you can't really know that. Of course, you can still prepare for it. Let's say that over the weekend, there's a big political event happening, let's say an election result, or anything that could be high impact for the markets. Is it really a good idea to hold the trade over the weekend? Probably not. So that's another way that you can prepare yourself, just in a general common sense way for fundamental events. Because if you're as you know, the markets close on a weekend and open in the weekdays. So 10 o'clock comes on a Friday night, you've forgotten to close your pound yen position, and there's a Japanese political event that could be occurring over the weekend, then you're basically setting yourself up for huge event risk, which is like an unknown event that you can't control, and you really can't control it because the market's closed. You can't even edit your position. So you might know that it's gone potentially against you, but you can do nothing about it because you can't enter the broker to change that position because the market's closed. So another point there, do not really enter positions when you know that there's a high risk of a potential volatility over the weekend. In general, it's kind of okay, depending on the strategy you use to hold positions over the weekend. But the problem is, let's say that you enter here again, you've got to stop there, target here. This could be, I don't know, let's say you're day trading, that's 20 pips, that's 25 pips. That's fine in a normal environment. Then the market closes maybe a few hours later, and on a bad news event, the market could actually gap up and open here. So the market's opening past your stop loss, and you'll then be stopped out at a worse price than you wanted, so you're taking on even more risk without knowing it. So there's lots of these little pointers that, obviously, if you're brand new, you're not going to really know that, and that could save you some money in the long run. So what we've covered so far is, in general, don't enter trades right before potentially high impact news. Don't enter trades on like a Friday afternoon or a Friday night if you know that there's going to be potentially high impact news events occurring over the weekend. So other things that aren't scheduled are things like speeches. Well, they're scheduled, but you don't know exactly if a comment's going to be made or when in that hour the comment's going to be made. So let's say that you have something like a central bank press conference. So the ECB have done their rate decision, nothing happened, they just kept it as expected. The market stays the same. You might be thinking, right, interest rate decision's done, now I can enter because that nothing's clearly happened after that. But then in a half an hour's time, you have the press conference. If you're not aware of that, you might enter the trade here. Let's say the governor says something in the press conference that sends the market flying. You've just been stopped out and taken on that risk because you didn't realize that. So remember that speeches, even though the comments aren't always scheduled, you don't know what they're going to say, they may or may not say something that can spook the market. And it could be the case that they say something spooks the market, and then someone asks them a question in the Q&A, they clarify what they said, and then the market dumps right back down again because they've just repriced out what they just priced in because they misunderstood what the governor said. So fundamentals are an absolute minefield like that. You can't really predict it. You just have to play it by ear, basically. So yeah, just avoid entering positions that close to news. And like I said, there's no quantifiable time like not to enter. Just don't be silly about it. If there's massive news coming out on the day, wait for that to be finished first. It's always worth not taking the risk if you're trying to trade properly than just taking a 50-50 gamble and just hoping it goes the right way. Things like removing your stop loss as well, just in case the market makes a spike, not a great idea, because if the market does make a spike and continues that way, it can go up very quickly, very sharply. You're now taking 3 times the risk you wanted to begin with, and then you're stuck offside. So lots of like easy mistakes you could make because you think it makes sense, but it just really doesn't in the long run. So one thing where this could be different is, let's say the market builds up some resistance there. It's a pretty big level. It's all the way down here, let's say, and there's a big news event coming out. It's now different if you set a limit order up here than it is if the market is already close to that. Because in this instance, we know the market can often spike on news and data, and then often it doesn't continue going in that direction over most of the time. So it could be a way that you can catch a top or catch a bottom. Obviously, this is like, you would have to have an actual strategy for this. I'm just saying this is one of the acceptable times to place trades around news, is when the market is quite far away from an area that you're looking to get in. So let's say that the market is here, a big news event comes out, NFP, spikes the market up, comes into your area, you look for sales around here, and then it sort of mean reverts back here again. You've made some money. So you need a proper strategy for that, but that's different than if the market's already around this area. Of course, you can see why that's different. There's less risk involved in that trade. So there's no quantifiable amount of pips. Depends on what your strategy is, depends on what the news event is. That could be 10 pips if it's a 5-minute chart. That could be 100 pips if it's a daily chart. It's all different. But you get this sort of general gist and general idea. So the final thing to look at is, what if you're already in a trade? So let's say that you have a retest, you got in yesterday, so you got in here roughly. The market's now somewhere around here. Your stop, let's say, is there, and your target's down here. So you're in a trade, you're in some profit, and there's high impact news event coming out soon. Now, of course, this is going to depend on the strategy that you're using, which you'll find out over time. But in general, it's probably more acceptable to keep the trade open now because you are already in some profit. You can obviously manage your risk maybe by moving the stop down, but then that does expose you more to a spike. So there's so many variables here. I can't really give you unlike the other examples I gave, I can't really give a specific strategy here because also you would need a strategy depending on what you're doing. This depends on the time frame, the number of pips in between, what the news event is, the context surrounding the news event. All this sort of stuff matters, of course. There's too many variables to go through now, but it's more acceptable to keep a trade open. There's different things you can do. You could maybe take off half the position, take a bit of profit off. So you're still taking the gamble that it could spike you out, but again, it could also spike you into more profit. So let's say that you're already in a bit of profit. You might want to de-risk slightly. If it's like a really high impact central bank event, you might say, right, I'll take off half the position. Close half your position here. You've taken some profit. If it goes against you and you get stopped out, you might end up being break even. You might want to move that to break even, your stop loss. There's many things you can do. You get the point. But I'm not going to go through those now because you need an actual strategy first before you start thinking about that. So there's just a brief sort of intro to trading around the news, what to be really aware of, the obvious points, and then the less obvious points you can develop over time. So that's actually it. So that's all from me. I hope you've enjoyed it. I hope that you found it very useful. And of course, if you are unsure about certain parts, I definitely recommend going back, watching them again, doing some more reading and just making sure that you've got solid knowledge of what we've gone through. So like I said, that's all from me for now. And I'm sure I will see you guys later down the line in your trading journey.